Let's talk about something you hear all the time, probably every single day on the news, the Dow Jones Industrial Average. You know it, right? Most of us just call it the Dow.
You know the drill. You turn on the TV and the anchor says something like, "The market was up today," or maybe, "The market took a nosedive." Well, 9 times out of 10, when they say the market, what they're really talking about is the Dow. So what on earth is it?
All right, so let's get right into it. What exactly is this thing that gets so much airtime?
I love this analogy. The easiest way to think about the Dow is, well, it's like a thermometer for the US economy. It's not the full, detailed weather report, but it gives you a super quick, easy-to-read snapshot of whether things are generally heating up or cooling down.
So here's the more official textbook definition. The Dow is a stock market index, which is just a fancy way of saying it's a curated list. And this particular list follows the stock performance of 30 of the biggest, most influential public companies in America.
And that right there is the magic number you have to remember, 30. That's it, not hundreds, not thousands, just 30 companies. They're handpicked to basically represent the health of the entire US economy. Talk about an exclusive club, right?
Okay, so how does this exclusive club of 30 actually work? Because this is where the Dow gets, let's say, a little bit quirky. We got to break down its very unique mechanics.
So, you might think there's some complex computer algorithm picking these companies, but nope. It's actually a committee of real people, editors from S&P Dow Jones Indices and the Wall Street Journal. They get together and make the call. And they're not just looking at numbers. They're looking for companies with a stellar reputation, a long history of growth, and, companies that lots of people are actually invested in. It really is more of an art than a science.
Now listen up, because this is probably the single most important and frankly most criticized thing about the Dow. It is price-weighted, and this makes it fundamentally different from almost every other major index out there.
So how does price weighting work? It's actually shockingly simple. You literally just add up the per-share price of all 30 stocks. Then you divide that big number by something called the Dow divisor, which is just a special number that helps keep things consistent when stocks split or companies change. But here's the key takeaway, the weird part. A company with a $400 stock has way more influence on the Dow's movement than a huge, massive company with a $50 stock. It's all about the share price, not the total value of the company. Kind of strange, right?
The Dow has been around since 1896, a long time. And because of that, it's changed a lot over the years. It's almost like a living history of the American economy itself. It didn't even start with 30 companies. Back in the day, it was just 12 industrial powerhouses. Then it grew to 20 in 1916, and finally, it hit that magic number of 30 back in 1928. So it's been in its current form for a very, very long time.
And check this out. This table really tells the whole story. The original Dow was full of names like American Tobacco and U.S. Rubber, industrial giants. Today, it's dominated by tech and finance companies you use every day, like Apple, Visa, and Microsoft. The name Industrial Average is still there, but the index itself has totally transformed.
So all this brings us to the big debate you hear in the financial world. For all its history and fame, a lot of experts argue that the Dow just isn't the best way to measure the market anymore. They say there's a better tool for the job, the S&P 500.
So let's put them head to head. The Dow, 30 companies. The S&P, a whopping 500. The Dow, as we know, is price-weighted. The S&P, on the other hand, is market cap-weighted. That just means a company's total value determines its influence, which many feel is a much fairer representation. And finally, the Dow is picked by committee, while the S&P 500 uses a strict formula.
So the arguments against the Dow really boil down to this. First, 30 companies is just too small of a sample size to represent the entire massive U.S. economy. And second, that whole price weighting thing is seen as an old, outdated method that doesn't really show a company's true importance.
Okay, so if it's got all these flaws, why do we still hear about it constantly, every single day? Well, because despite all the criticism, the Dow absolutely, positively still matters. For starters, it's an incredible historical benchmark. It's been telling the story of American business for over 125 years. Plus, it tracks what we call blue-chip stocks. These are the massive, stable, household name companies. Their success is deeply connected to how regular Americans are spending their money. So if the Dow's up, it's usually a pretty good sign for the broader economy.
Which kind of leaves us with this final thought. Is the Dow just an outdated relic from the 19th century that we can't let go of? Or
is its very simplicity, and its focus on America's biggest, most iconic companies, what makes it a timeless snapshot of our economic health. The debate isn't going away anytime soon, but now, at least you know exactly what they're all arguing about.